So, good morning, ladies and gentlemen. Welcome to Czech National Bank meeting with analysts. Today we will present you our new macroeconomic forecast, which was prepared by our forecasting team. After the presentation, we will open the floor for your questions and further discussion. We have our speakers here, Czech National Bank Board member Jakub Seidler, then Executive Director of Monetary Department, Mr. Petr Sklenář, and Deputy Executive Director of Monetary Department, Mr. Jakub Matějů. And Mr. Sklenář will start with presentation.
Again, good morning to everyone. I would start with a small comment. My dear former colleagues, I'm very glad that I can welcome you here in this meeting hall as a speaker, but at the same time sit next to Jakub Seidler as a board member. Someone could say it's a big change for me. I would say no, because I realized that I used to always sit next to Jakub at the same side of the table, so there is no change for me. However, I would like to still start with some change at this presentation, maybe to show you some different point of view on some issues or thinking out of the box, slightly different. After previous shocks, this economy came through the dynamics of the main aggregates, we can say, have returned to the normal. The growth of nominal GDP is slightly above the 5%. In real terms, it's close to 2.5%, so we'd say we are close to the normal. The pace of the growth of household spending in nominal terms is around 6%. At the same time, the wage growth is still elevated, and it's above close to 7%, or slightly below the 7%. So, and at the same time, the previous gap toward the potential is gradually closing, and it will be probably close at the beginning of the next year. So this is the one side of the situation of the economy where we are. And another issue is, I would say, price dynamics, or the dynamics inside the consumer basket, or what we can see below the surface of the fissure. When we split the consumer basket to the different categories according to the price change, and when we compare it to the previous decade, what we can see that in previous decade, almost 60% of items inside the consumer basket have a price growth slower or lower than 2%. It was up 2%. Now this share is significantly slower, or lower, sorry. And on the other hand, on the other side, half of the consumer basket has price growth higher than 3%. We can find a similar picture of the price dynamics when we use, for example, median inflation, because the median inflation for June was 3.8. So we are in the situation where the economy has been gradually picking up speed, and in terms of dynamics is close to what we'd say normal. But the overall price development has not stabilized, and the disinflation process has not been fully completed. Long story short, that were one of the thoughts we have during the preparing of this new forecast, and to see what the point, or in what situation the Czech economy currently is. So, and now I would like to turn to the, say, more standard part of the presentation, and to introduce you the forecast and model assumptions. I would split it into three categories. The first were about it's the assumption. We assume that the tariffs on the European export to US will be of 10% and 25% on selected sectors. It was, in fact, the assumption of the previous forecast from May. We use this further, and in fact, it's very close to the proposed US deal in terms of quantity and quality, I would say. The new forecast includes the year 2027, and we have to assess the impact of the new scheme EU ETS2 on inflation, and we use assumption that the primary inflation impact would be around 0.7 percentage points, and second round effect around 0.2 percentage points. The central bank would not react on the primary effects, but would consider it as administrative factors, and would react only on the second round effects. The second type, I would say, the assumptions is about the inflation development and inflation risks. Those risks were in previous forecasts mentioned as risk. And we put it into the baseline because we think that these risks are materialized. One of it is that the growth of wages will be higher, or the slowdown will be more gradual. Another risk is higher growth of household prices resulted in higher imputed rent. And the third risk is higher inflation expectations. What we can see in service sectors and higher markups of companies in service sectors. And the last change of the model is that we reduce the neutral rate for the ECB by 25 basis points to 2.25. And I would say it's mainly reaction to the current state of affairs. What the financial markets expect, that what the ECB will do, or what the ECB itself says about the direction of the monetary policy. Now, and another thing is in fact input for us. It is the foreign economic development, and we see that this year the growth or the economic development overall would be influenced by uncertainty in global trade. The economic growth should be a little bit subdued. Next year, a fiscal stimulus in Germany should speed up the growth of the German economy or the European economy, and the growth of the German economy should be close to the 2% next year. From the point of view of costs, this year producer prices abroad are subdued, thanks to the decline in energy prices mainly, and the expected rebound of the economic activity next year should as well influence the dynamics of producer prices in the second half of next year and in 2027. Another important factor is, and for us, anti-inflationary factor is stronger euro as a result of the development in the financial markets since April. In terms of interest rates, we expect that the ECB is close to the end of its cutting cycle, but still at the end of this year there could be one more cut in the interest rates, and the Fed should restore its cutting cycle during the autumn, gradually. And now, when we turn to our outlook for the domestic inflation, in general, we think that this year the headline inflation should be in upper half of the tolerance band. and gradually decline to the target of 2% at the end of the next year. The monetary relevant inflation should be slightly below the headline inflation for the whole forecasting horizon. The core inflation, which is currently slightly below the 3%, should gradually return to the level of 2% at the end of the next year. When we compare this forecast with the previous one, we can see this significantly higher, and it's mainly about the changes in the model, as I spoke about it at the beginning. And in the 2027, there is increase in inflation, and it's caused by the assessing the impact of the EU ETS to our forecast. Again, when we could slightly talk about the structure of the inflation, the main factors of the inflation this year and next years will be higher, or the contribution of the core inflation and the food prices. But both these factors should gradually slow down next year and help return the inflation close to the level of 2%. In 2027, there will be again pickup of the whole inflation, overall inflation, and it's caused by the energy prices as the result of the introduction of EU ETS2 in the European Union. In terms of core inflation, a very important factor is imputed rent, but we think that we are close to the peak of this level, and it would not further accelerate, but will very gradually slow down during the next year and in 2027, as we expect a little bit lower growth of houses next year. In terms of cost pressure, we expect that the cost pressure will weaken during the next year and return to the level of 2%. One side, it should be lower wage growth, what we expect in the projection, and acceleration of the economy should gradually renew growth in labor efficiency and help to reduce the cost pressure inside of the economy. Still, the overall cost pressure will be slightly elevated, and its effect of I would say, a strong domestic impact, strong domestic demand in the economy. But still, we expect that the cost pressure or the overall cost pressure in the economy will gradually slow down during the forecasting horizon. And it's, in fact, a result of a little bit tighter monetary conditions. In terms of the GDP statistics, we expect that the growth of the Czech economy should be this year around 2.6%, and the same for the next year. In 2027, as a result of I would say, renewed economic activity in Europe, it could be close even to 3%. Still, the main driver of the growth this year, next year, and in 2027 should be the domestic demand, mainly the household consumption as a result of higher wage growth. And in 2027, we expect a positive contribution from the export as a result of higher growth in Western European trading partners. The flash estimate for second quarter was slightly below of our estimate, but still we don't see that it could threaten the whole outlook. Maybe there could be reason for some positive surprises or changes of this estimate. But still, we expect that the growth of the Czech economy will continue in the second half of this year and the next year, mainly due to the domestic demand. And this is how we see some parts of the demand. As I said, the main driver of the economic growth should be household consumption. We expect that the growth in real terms of household consumption should be this and next year around 3%, mainly due to swift growth of wages and gradual decrease in the saving rates, and stay quite positive environment for the consumer. Low unemployment rate, some increased optimism of consumer confidence and so on, and gradual deceleration of the household consumption in 2027 as we moving closer to say neutral or steady state. The government consumption, as a result of some consolidation, should gradually slow down, and there will be some fading impact of externally food-related spendings, and we don't expect any change from the new government. Will be here after the election. In terms of investment, this year and the beginning of the next year, the investment demand should be driven by the renewed formation of inventories. As the growth increase in our trading partners, we expect that there will be some increase of the fixed investment in the next year and in 2027. As I said, in terms of net export, the contribution of next export this year and next year should be relatively weak or small. This year, the export are some subdued, as I said, about the impact of trading wars or complicated situation in the global international trade. As we expect the speed up of the growth in Germany and other main trading partners, we expect that this contribution of next export will turn to the positive and will be one of the driver of the growth in 2027. And in terms of exchange rate, we expect that or we use in our forecast for this quarter that the exchange rate would be around 23.8 of koruna to euro, and we expect that the koruna would be relatively stable around this level for the whole forecasting horizon. There are changes. What could we influence is that it's a wider interest rate differential, whereas the euro, as I said, it's the results of the change of the model assumption about the ECB. There is a higher trade surplus, and we saw significantly stronger exchange rate in the second quarter. So, in fact, the initial conditions help change the trajectory of the exchange rate, and as it's one of the main difference between the previous forecast. So in general, we expect a relatively stable exchange rate for the whole forecasting horizon. The interest rate outlook or projected trajectory significantly increased in comparison to the previous forecast. And it's a result of, I would say, two types of changes. One of the expert adjustments. It's about turning some previous inflation risks into the baseline. It's about the higher growth of highest growth of house prices, higher inflation expectations or elevated profit margins, and very gradual slowdown of elevated wage growth. And we can also add to this the second round effects of emissions, ETS2, because the monetary policy would react on the second round effects, and it always included in the forecasting horizon. And one of the other important changes is change of the model. As I said, is the equilibrium rate for the ECB, which was reduced by 25 basis points. And in fact, in the logic of the model, we have to compensate it in domestic interest rates and reduce this compensated the increased risk premia to Corona. And the foreign environment contributes to slightly lower rates, mainly to the stronger euro, as I said, because it's for us, in fact, anti-inflationary impact or factor. If I should just summarize the whole the new forecast, the inflation should be this year in the higher tolerance band and should slow down next year. In 2027, the headline inflation will be influenced by the ETS2 scheme and will increase around 3 or 4 percentage point. Will increase to the 2.5. The growth should be solid through the whole forecasting horizon. This and next year should be driven mainly by the domestic demand, by the rebound of household consumption, and in 2027 it should be also supported by the impact of the foreign demand. The interest rates, according to model projection, is that should slightly decline in this year, but it should be compensated in the next year. It should slightly increase, reflecting the rising inflation pressure in the economy, as I said, mainly about the reaction to the ETS2 scheme. In general, we could say that it's almost projected interest rate stability. The Corona should be stable for the whole forecasting horizon. One of the important factors should be increased impact of interest rate differential and gradually recovering of productivity. As I said, it should reduce the cost pressures and as well support the Corona for the 2027. We as well prepare some scenarios. One of the important risk or factor for this projection is to assessing the impact of the emission trading system EU ETS2. We expect that what could happen if the impact of this scheme is twice as large as we expect in the baseline. And again, hold the same condition that the ECB should react only to the second round effects, not the primary effect. The second round effects in these scenarios are twice as strong as they are in the May scenario. And in this situation, in the logic of the model, it requires slightly higher interest rates. And these higher interest rates led to slightly stronger corona. The impact in this scenario on the economic growth as a result of the high interest rates is quite negligible or small. But what's a very important factor is that the inflation should be almost close to the level of 3% in this scenario, and it will require very good communication of the central bank that's the only first round effect, and it will gradually fading away, and central bank react to the second round effects of this in this case of the scenario. But I said it's one of the important factors, but there is still a lot of uncertainties and risks about how this scheme will react, how the Czech government could in some way reduce the impact or offset the impact or change the whole impact of this scheme. So it could be again source of news scenario in the next forecast. When I return to the risk metrics, as we usually do for our baseline forecast, as I said, one of is the persistent of unfavorable price growth structure. That's the reason the risk I was talking at the beginning of this presentation, that the half of the consumer basket has a price growth higher than 3%. On the other hand, anti-inflation factor currently for the forecast is stronger corona. A little bit. On the other hand, at the end of the forecast horizon, mainly for the 2027, it could be stronger impact of new ETS2 scheme introduction. What's in general and doesn't change is increase risk of higher or stable structure deficit of public finance. And there are also, as well the uncertainties, not the risk, as the development of trade wars. It could develop on both sides, as well as the real estate and price growth and inflation in services, because we included into the baseline, so they are now moved to uncertainties, not as a risk. And another inflation risk is the impact of increased public spending in Europe, not only about the structure, but as well about the national defense. And it's included in the baseline, but still there are uncertainties. How will it develop during the next year and 2027? And as well, then another global politics impacts, as a war in Ukraine or in the unrest in the Middle East could influence the forecast, but the impact is slightly lower than it was expected in the previous forecast. So this is our spring, summer forecast in summary, and we are ready for your questions.
Okay, perfect. Thank you very much. So it's time for questions. Just don't forget to activate your microphone before you speak and shortly introduce yourself, please. So who's first? Yeah, Mr. Haverland.
Thank you very much for your presentation. David Haveland from ING. I've got 4 questions. First one, what drives the dip in interest rates in the second half of 2025? We see it's helped a lot to the upward side by expert judgment and model change, but what's the story? And the kind of mirror of this, what's driving the weakening of the koruna against the euro once again on the forecast horizon? The second question is, you said that the previous risks are incorporated in the forecast currently. And my question is, are you not worried about the rents development and its effect to core inflation? So are the risks incorporated fully, or to which extent? My third question is, you reduced the ECB base rate, the equilibrium one, and I'd like to know what's the kind of thinking behind this move, because recently we have seen deglobalization, reshoring, kind of restraining immigration. So globally, I believe it's more pro-inflationary environment, which would maybe deserve even higher rates in the long term, and you go lower. So is behind that the demographic development or lowering the potential growth in the Eurozone? I believe it's a bit more kind of complex issue, and it drives the Czech base rate upwards. So what's behind that? And the last question is about the emissions allowances for households. I know it's very difficult to quantify the effect, but did you not consider some front-loading of the effect into 2026 already into consumer prices? Thank you.
Yeah, maybe I'll start with answering the question on the PRIBOR trajectory dip or decline, slight decline, a marginal one, which is expected in the baseline scenario. So there are several factors. With the maybe most important one is the foreign environment with lower foreign inflation pressures. I mean, all of this is visible in our decomposition of the trajectory. With also ECB rates going already substantially down, even below our new revised steady state for the ECB. So if it goes below 2% with one further cut, this implies expansionary monetary policy in the euro area, which also translates to our economy. So this would be the main factor. But looking also at the whole economy, the output gap is still considered as negative and closing these quarters and going into next year. So in this situation, with ECB gap being to the expansionary side and domestic output gap still open to the negative territory, there is like mild, let's say, dip in domestic rates.
About the exchange rate, it's a part of our forecast or input of the foreign development, because the financial markets expect that the ECB will gradually increase the interest rates during the second half of 2026 and at the beginning of 2027. Small, but and that's the reason that there will be some closing of effect of the interest rate differential between the domestic interest rates and foreign interest rates, and it led to the in fact stable exchange rate. It offset other factors. So the reason for the very small or negligible weakening of the koruna is the results of the reduced interest rate differential between the ECB and domestic interest rates. In terms of imputed rent, we think that, as I said, we are close to the peak of this impact of this risk, and it would not further accelerate. It would be a very important factor for the core inflation for the rest of this year, and even further, we expect that the slowdown of the dynamics and house prices will be very gradual and will to influence the core inflation as well in the next year. But as I said, we expect that we are close to the peak of the factor. And in fact, the today released the figure of the inflation for July slightly support our view in this term. In terms of emission allowances, yes, this could happen. It's one of the part of the uncertainties or risk, but we still consider that the main impact will happen at the beginning of the 2027, but it's expected factor, and as I said, the reaction function of the central banks take it into account already during the 2026, and should gradually increase or tighten the conditions in advance, not at the beginning of the 2027. But still, this impact, if there is some front-loading, it would heavily depend what would be the overall condition of this scheme in the Czech Republic. Whether there will be some compensation from the Czech government. We can think that could be some reduction of another taxes, for example, as to offset this impact. But still, we don't know. And in fact, we expect in this our baseline that there will be some still unknown steps of the unknown government, which will try to, at least in some way, offset the impact of this scheme. And we do not expect that there will be full impact of ETS2 on consumer prices without any offsetting or something like that from the government. In terms of ECB, as I said, it was mainly the reaction to the current state of affairs. We decided to make some changes in the model, and this change was considered for a long time, and we did it now because we think that the bar for the ECB was too high, and the ECB itself and the financial expectations confirm is that the we can say neutral rate or neutral rate for the ECB is slightly above the 2.2%. When you look on for example, a curve on money markets, or it's slightly above the 2%. And when we would have the 2.5% for the ECB's neutral rate, it's suggesting slightly stronger monetary policy of ECB than is expected on the financial markets. And we try to put it in the say, condition of the real world. And
the Czech long-term equilibrium rate remains at 3%?
Yeah.
Unchanged?
Yeah. It's only about the ECB rate, not about the domestic rate.
Okay, so next question, yeah, so Mr. Schindel and then, so Mr. Paul, yeah.
Martin Paul, General Investments. I have a follow-up question to the effects of higher ECB equilibrium rate. Frankly speaking, I struggle a bit with the implications that 25 basis lower equilibrium rate of the ECB in the decomposition adds 25 basis points to the interest rate path. In the commentary, there is mentioned higher risk premium and so on. Could you elaborate on it a bit more in detail? And the second question relates to the revision of this year growth forecast. It's basically about net exports. In the first half or also at the end of the last year, we observed globally quite a lot of volatility in trade data. It was related to tariffs, some pre-stocking, whether the forecasts, whether there are some, let's say, adjustments to a possible correction in this dynamic after the tariffs are clarified, or whether it's just simply, you know, so sort of continuation of the current trends. Thank you.
In terms of ECB rate, in the logical model, it's connected with the uncovered interest parity. When we lower the neutral rate for the foreign interest rate, the equilibrium, and to decompose it in the history, you have to increase the domestic interest rate, increase the domestic interest rate to offset the, in fact, increase in the risk premium for the corona.
Yeah, I can I can try to comment also. One thing is the equilibrium relationships in the UIP. So to make that hold without changing your assumption on expected appreciation of corona, you need to put it somewhere, which is the risk premium. So we solve the let's say the equilibrium condition by increasing risk premium, and then we move on to the like cyclical or off equilibrium values, and there we see less expansionary ECB, less expansionary ECB after the revision, which also implies via the like deviations of equilibrium in the UIP, less expansionary check. So. Yeah, but in effect, this what Petr also said also holds. In fact, is like compensating for the increased risk premium.
In terms of foreign trade and uncertainty, we try to find out in last data what could be the impact of this front loading and so on, and it's difficult to find it in fact in Czech data, or the impact is quite small. Long story short, we do not have any extra adjustments to this factor for the export, because it's very difficult to find it in results for the first and second quarter. It could be close to some white noise or something like that, if there is some, and it's difficult to identify. So it's hard for us to put it in the forecast because we don't know what's the magnitude of this effect. So there is no such adjustments in this term.
Okay, so Mr. Schindler, if you want.
Thank you very much. My name is Jaromír Schindler from the Czech Banking Association. I have two questions or one note. The first one is regarding the communication. Thank you for this presentation, which is a little bit different compared to the previous one because you emphasize the story behind, which is very useful, I think, but at the same time, we do not have numbers. Yeah, because you haven't yet published the numbers behind the story, so I think it would be helpful if we have numbers in the morning and then we can really focus on the story behind. And so this is the note. And the first question. The second one is about your interest rate forecast. As was mentioned, you assume the fall in the interest rate, but at the same time, your core CPI forecast is still elevated, on the monetary policy horizon. Yeah. I'm sorry, I'm repeating these questions all the time. Yeah. So I still a little bit don't understand why you are proposing the cut in the policy rate with this elevated core CPI on the monetary policy horizon, which later leads to the higher policy rate. Yeah, so, and this question is also for Jakub Seidler, yeah, because how the bank board interpret this, from my perspective, not a strong logic, but simply I don't understand it. Thank you.
Okay, so good morning again. I will give some time to colleague to think through the more technical question, and I will start with a little bit policy perspective. We are now spending quite a lot of time with questions related to model, but there is always no good timing for methodological changes in model, that's for sure. It brings some effects which might be unclear, but important from my perspective or from board perspective is that the assessment of the board did not change much this time compared to the previous meetings. The assessment of the board is generally focusing on price level and how service inflation keeping to be relatively persistent, and we do not see disinflation in services as would be demanded. So from this kind of view, the general hawkish perspective did not change, and despite the fact that we see quite higher path of the interest rate in the main model, the total assessment of the board basically did not change compared to the previous meeting. So this is, from my perspective, one important fact. Still, we see core inflation, which is elevated, and this is the reason why the bank board see the current forecast as still pro-inflationary. And that's why we decided to stay on hold. But as I mentioned, the assessment is still influenced by the huge uncertainty related to the trade wars, that's for sure. So basically, a lot of board members were inclining to see current level of rates as close to neutral, and basically are suggesting that due to this inflationary risk and also your basically note related to core inflation, that we are very likely at the end of the cutting cycle, but conditioned by the huge uncertainty related to trade wars. So basically, this is clearly indicating why there is no forward guidance and why there is no clear statement that we are done with the cycle, because we still, and everyone, and basically this is consensus on the board, we still need to stay flexible because the uncertainty related to trade wars still remain very huge. So this maybe brings some clarity related to policymaking perspective, and I will pass the word.
Okay, so two points to make. First of all, you should still see the trajectory as a technical outcome of the model and not the recommendation itself, which will be revealed in 6 years, 6.5 So this is one point to make. Second, that the revision in rates is already quite substantial to the upside, and the details, how this translate to individual quarters, depends on different impulse responses of the shocks we use to do these expert adjustments. So I would see this like slight decline and again increase as a something of a technical result of how this is implemented. But there is also a story to that, because we see the impacts of ETS, the secondary ones, kicking in 27, so that warrants a stricter monetary response to the secondary impacts, which starts to pick up in 26 in a forward-looking manner, while more recently there is a little bit less results for the restriction as viewed by the model.
Okay, Mr. Sobíšek.
Pavel Sobíšek, Unicredit Bank. What strikes me, how upbeat your assumptions are about German economy for 26 and also 27. I'm not sure if your assumption is purely consensus driven, or whether there are some elements of your own in it, but I would be interested in your story behind it. Thank you.
One of the main important factor is the impact of the fiscal impulse for the economy, as well accompanied by some at least very small or gradual cyclical recovery of the economy, because we can see that there is increase of loan demand in Europe, not only in Germany. The leading indicators, even in Germany, returning to the say neutral level. Some increase of expectations among households as well among the firms close to the neutral. At the same time, we expect the fiscal impulse. Still, we not expect some extraordinary growth for Germany. It's something between 1% and 2%. I think it's a little bit more optimistic than it was for previous decade, but it's not, I would say, over optimistic.
Okay, so Mrs. Tenconi first, and then Mr. Costa, please.
Raffaella Tenconi from Wood & Company. I have 3 questions. The first one is on food inflation. I'm not sure if the bank has looked at what is really making food inflation so sticky, especially this year, whether you think it's more demand or climate change, or what is the share between these two. Second one is on wage growth. I'm interested to hear your thoughts about how sustainable do you think wage growth at 6% in nominal terms, which historically is fairly high for the Czech Republic, how sustainable it is for 2026 and 2027, and if you have a view on what you think is achievable labor productivity, that would be very helpful. And the last one is on the housing market, because if it were to maintain the same momentum that it has, and it's every year there is a question about whether it's gone too far in terms of price valuations, would you say is reasonable and prudent to expect banks to hold more capital going forward because of the housing market? Thank you.
If we start with the sticky inflation, as a joke, I would say it's bad luck, but no, there are different factors. at the end of last year, maybe at the beginning of this year, was more about the inflations in services. What we can see in last months, there is some decreasing momentum in some sectors in services. But unfortunately, there is increase of impact of higher house prices, which influence the imputed trend and core inflation and the whole inflation. So one positive development is offset by another factor. At the same time, in previous 1.5 years, there was in fact negative contribution from the goods or tradables. Again, in last two releases, June, July, maybe May, there was increased price growth of goods. Again, it compensated some slowdown in the services. Maybe, as I said at the beginning remark, that the overall price dynamics is not completely stable, or the disinflation process has not been completely fulfilled or completed, and it could require slightly tighter monetary conditions for a longer time. It's not about the one single factor, but we can see in different areas. For example, price changes of firms. We cannot say that the firms increase the prices significantly, an increase or the changes are higher than they used to be. But what we can say that the changes of prices are frequent, and it could be another sign of maybe higher inflation expectations or the sensitivity to the inflation. So they are relatively small, but many small factors influence the inflation development or the price development in the economy. And it's not about one simple factor. One of the very important factors for the stubbornly high or elevated inflation services is definitely wage growth. We can see that there is a slowdown, but it's more gradual than it was expected, and it's included in the new forecast. But we expect that the wage growth will gradually slow down and return to the normal level as the whole economy. Housing market, it's very difficult question, but not for me mainly. I would only can say that for us, an only important factor in terms of inflation, but for the bank board, it has many aspects, and I think it should be a better comment by the member of the board member.
I will just add a couple of notes to housing market, which is definitely observed, and we are discussing this topic relatively often. This is also a topic for the Financial Stability Department and macroprudential policy. And generally speaking, our experts believe that this year, double-digit dynamic of the housing market is to the large extent related to the fact that how debt capacity of the households increased relatively solidly, not only due to the real wage growth, but also due to the fact that mortgage rate declined broadly by more than 1 percentage point, which generates debt capacity. But when we look at a little bit longer term rates forecast, there is reasonable assumption that mortgage rates will not be basically declining at such pace as we saw in last 1.5 years, and that's why the debt capacity of the household should be not growing so fastly, and this should lead also to deceleration in property prices next year. Another fact is, of course, that Czech Republic have significantly long-term troubles in housing property market, but these are more structural issues also. So basically, this is always problematic for the central bank how to cope with that. But from the perspective of financial stability, macroprudential policy, experts are analyzing quite in detail way how new mortgages are generating systemic risk, either in a way that banks would be incorporating too risky loans into their balance sheets, or that currently dynamic is leading to the overdebtedness of households. And based on detailed analysis, they do not think that this is the case, and that's why the macroprudential policy has not been activated during the last macroprudential meeting. So this is maybe just from policymaker perspective. And maybe another one note to the food prices, which also a little bit could be related, why board stays in a little bit hawkish stance, because of course we know that from the central banking perspective, food prices are very volatile and usually not the items which are relevant for the monetary policy. But I think there is a couple of voices in the board that after a couple of years of double-digit inflation, the inflationary expectations could be more fragile. And that's why even food prices, which is usually not taken much into account, is now watched closely, because we could see that it could a little bit change the inflationary expectation from households. So that's why we are taking it now into account a little bit more than during the normal times. But after 2 years of this elevated inflation, I think it makes sense.
I'm sorry, I forgot to comment on food prices. I would only add one comment that what's very important factor in terms of food prices, that currently we have slightly higher growth of food prices this year, but it compensates the lower growth previous years. When we look at the development of price level of food, price level of food, and compare it to the other European countries, we can see that it's the total increase, for example, for last 2 or 3 years, it's lower than in other countries around, and it's, I would say, maybe close to the average of the Eurozone or Germany. So we cannot say that there is significant total increase of food prices. There is only elevated the dynamics.
So, very last question from Mr. Costa.
Yeah, thank you. Let me just go back to, it's a quick question because, I mean, a lot has been answered on input prices, but I believe you mentioned at a certain point you expect that to peak around here, and if you could elaborate a little bit more on that. And a second question is, let's say that, real estate prices continue at a very solid pace, macroprudential measures, what sort of measures? I mean, it's not only, the amount of cash that can be held by banks, rather there's a plethora of potential macroprudential measures that can be activated here. What kind of measures is the central bank or the Financial Stability Board looking at? If the central bank is actually looking at international examples or cases, right? Israel is one very good case. They've been struggling with rental inflation for decades. So if there's any work on this direction.
Okay, I will just start with this topic. To be honest, I do not want to front load what macroprudential policy will do, because we have different kind of meetings which are related to macropru. So basically, it's not surprising that the board is looking at the topic, but as I mentioned in my previous answer, this is also important from whether it's generating the systemic risk for the bank or households, as I mentioned. Yeah. So we have some options which can do based on our base legislation, which is in the Czech Republic active, but of course our experts are looking also on different possibilities. But right now, even from mortgage market dynamic, when we see a new mortgage rate deflated by prices of properties or by CPI, we are getting basically to the levels which were quite normal in some way. So we do not see that something excessive right now. It's quite, I would say, natural that after years of muted growth, we see some pickup, which is also related to the lower interest rate, as I mentioned. But our expert in the financial stability department does not assess that as some kind of excessive development.
In terms of imputed, it's about our forecasting of the development of house prices, and it's all about the dynamics. We expect that we are the peaks in terms of dynamics. For this year, we expect the growth of house prices around 11%, and for next year, 7%. Because if there was some effect of reducing interest rates, it's probably gone, and there will be no extra other factors to support the demand or the price dynamic. So in these terms, we think that the price level of the interest rate, the level of interest rates is restrictive for some households, and it will reduce the dynamics. As I said, it's not the growth. The house prices will continue growth, but in lower pace.
Thank you.
Okay, so thank you very much for your participation. Many thanks to our speakers. And I would just add that further information will be in our monetary policy report, which will be published next Friday, August 15. So thank you very much and goodbye.
Thank you. Bye-bye.
Bye.